Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. Hey, Paul, what's going on, bud?
What's up, man? How you doing?
I'm good, man. Just got back from our last football game. So we
Nice.
ended the season with a 500 record with a win today. So that was fun. And,
Great.
you know, it was like real football weather. It was like in the 40s, a
Ooh.
little windy. You know, the boys had little hand warmers on the sidelines. And luckily, it's 9-man football and we only had 10 players. So we actually borrowed 2 players from the other team that played just before us. We're like, hey,
Yeah.
you know, it's the same city league. So hey, you guys want to play another game? So that was helpful. But yeah, it was a lot of fun, man. Finish up the football season and now on to hockey.
Oh, yeah. The rich man's sport.
Well, it's the everyman sport in Minnesota.
Yeah.
It's, hey, do you want to, here's one way to be middle class. Start out rich and let your kids play hockey.
That's right.
Yeah. Then you can be middle class. So that's about what it's like. It's crazy. Last year I probably should have got hockey insurance on him because he broke his arm. And they started this thing with sports insurance. I don't know when that started, but you can buy insurance for your kid. If they get injured, you get reimbursed, pro rata that portion of the fee for that whole season. Yeah. When you're talking like, $2,000, $3,000, $4,000 of just club fees to play. Yeah.
Right.
It might be worth it.
Huh.
Yeah. But I typically don't because I self-insure for that kind of stuff. As Nelson says.
That's
right. Yeah. I can handle that if I need to. Yeah. Well, all right, man. So what are we going to talk about today?
We're going to talk IBC and for real estate investors.
All right. I mean, these things go together like peanut butter and jelly, like macaroni and cheese.
There you go.
We could keep going.
Peanut butter and fluff.
Yeah, like cocaine and waffles.
What?
That's a Ricky Bobby.
Yeah, I know.
Yeah. But yeah, IBC for the real estate investor. I tell you, why don't we both just spend a couple minutes rehashing our real estate journeys? Because for those who haven't been with us from the beginning or listened to the first couple episodes, they may not know our background in real estate. So Paul and I have both been in real estate. I quit my corporate job after 2.5 years in 2017 and did real estate investing full time. Call it real estate investing. Really, it was just flipping houses and flipping contracts, so wholesaling. But I ended up flipping my first house using a policy loan to fund the rehab. And that was great because your first flip, you think it's going to be 2 months, piece of cake, just got to finish off the basement, carpet, paint, call it good. No, it was 9 months, start to finish, firing contractors and kicking them in the butt, trying to get them to work. But the cool thing I realized that was the first time I ever took an actual, like a big loan from my policy. And what I discovered is, man, this is so stress-free because not only was I still earning on that money I took out against my cash value as a loan, I was still earning on that principal inside my policy, but I didn't have to pay it back. Nobody was calling me during dinner. Nobody was sending me letters, getting, collectors calling my house and leaving messages on my cell phone. Like, no, they didn't care. So I could wait until I sold that property and pay it back, which is exactly what I did. So that was kind of an eye-opening moment in 2016 when I realized, wow, I've got something here that's pretty powerful that I didn't even realize. And I was part of a mastermind group. And I will say during that mastermind, we would go to big events all over the world, really. I think we did one in Costa Rica and we invited the coach invited a infinite banking guy. Tom Lonnie came down and he was kind of like the face of IBC for that mastermind group, which is now humongous. And I think they have an event right now going on in Florida. But yeah, huge event. And I actually spoke at that event in 2017, I think. And but he was like IBC was spreading like wildfire within that group because, like I said, these two things, IBC and real estate investing, go so well. They complement each other so well. You could do both of them very well independently, but you bring them together. Some things that you mix together that are good apart don't do so well, like women and basketball. Like separately, they're both phenomenal. You bring them together, not, I mean, come on, let's be real. It's just not that great. But these two things, IBC and real estate investing, man, you bring these together and it's great. So that's my backstory. What's yours?
Yeah. Like, control over that banking function, Dave, is so powerful. No one, like you said, no bankers were calling you. And I think that was kind of your trigger in your life for realizing, I've had this asset for this many years, and now oh my gosh, it really is awesome, right? So mine is a little different. I never did any wholesaling or flipping. I was more of a buy and hold, single family. So I've got some mixed residential commercial down in Texas, and that was kind of my jam. And then I got into real estate syndicating and just basically being a capital provider to various syndications across the country. 5 of them, I think, now at this point. And similarly, I guess you could say I did some private lending to you early on in the flipping and wholesaling business. And what made that all possible was access to liquid capital.
Yep.
Right. And I have since liquidated, I suppose, most of my single family rentals. We sold 3 last year and did well. It was the peak of the market, so that was good timing. And I've got one left that I'll keep probably the next few years because it does very well for us as well. But yeah, that's kind of my story. More of a passive guy. Don't like to get my hands dirty. Don't want to deal with contractors. Don't want to unclog toilets. So that's kind of how I like provide, just providing capital.
Yeah, no, and I'm with you too. And I would never have known that had I not done that in the first place, been an active investor. Now I've got no desire, as Garrett Gunderson lays out in some of his books, which I highly recommend his books, Killing Sacred Cows and Disrupting Sacred Cows. He talks about your investor DNA. And I realized, man, owning single family homes, it's not my investor DNA. Flipping homes, not my investor DNA. I just don't enjoy it. So
that's right.
I'm with you. I'm very passive right now with my money. And I couldn't be happier because, the stress level is almost non-existent.
Yeah.
No stress.
I will say that seems to be where a lot of real estate investors begin. And I don't know if it's because all of these masterminds and coaching groups and, education that people buy, the fix and flip is the most, there's shows about it on television, on HGTV.
Right. It's sexy.
It's, right. Everyone's just crushing it. And look at the after repair value of this piece of crap that I bought in Los Angeles. But it seems like a lot of the people we personally know progressed from that business, from that space, which is very active. It's very constant, right?
Yeah.
It's highly taxed, as our friend Steven would like to say all the time. And they naturally progress to, look at this commercial real estate thing that has economies of scale and a little bit more involved, of course, or a lot more involved, I suppose, but bigger rewards, I think, later on, and especially on the tax side of things.
Yeah. Well, I think there's a couple reasons for that being where most people start is because, one, that's the quickest place I could think of to start generating revenue.
Sure.
To start making, like, earning an income was flipping and wholesaling. Like, it's a lot of work, both of those. Don't let any idiot tell you that wholesaling is 4 hours a week. Like, no, it's a lot of work, especially if you want to make money in it and not spend 100 hours doing it every week. But it's a phenomenal place also to cut your teeth on, just at being an investor, evaluating deals, dealing with people, knowing what issues might come up in everything, and knowing how to work with contractors and contracts, like reading and writing contracts, like highly important, and dealing with all the snakes that are out there
Oh
in the
yeah.
real estate world. I mean, that's another reason I didn't really care for it, because you deal with some pretty unsavory characters. So everybody has their stories. I mean, I hired a bank robber, for goodness sake. So
Right. Yeah, we
um,
talked about that.
yeah,
And she was good at her job though.
she was really good. Yeah.
On both, both the, criminal activity and the legitimate
She did get
activity.
caught though, so she
Right.
wasn't that good of a bank robber. She did rob 5 banks though. So if you guys want more on that story, go flip through one of the previous episodes. But so let's talk about some of the reasons, like our favorite reasons why this is so good for real estate investors. So what do you have there for one of the reasons for you, Paul?
Well, we all hear about this, whether you're listening to someone else on YouTube, but leverage. A life insurance cash value or policy loan, which is kind of like, I guess you could equate it. The closest banking product is probably like a HELOC, a home equity line of credit, right? Interest only home equity.
Right,
line of
with
credit.
the mechanics of how it works.
The mechanics. But a life insurance policy loan, and I've probably said this before, it's the best borrowing position you are going to find anywhere in the world, other than like you have a rich father-in-law and he just gives you money or something, right? And with no interest or something. But
Right.
it is the best borrowing position that one could find themselves in.
Yeah, the most favorable terms you can find.
No question.
Yeah.
It's not debatable either. It's not.
Right.
I'm not making this up. It's true.
Yeah. If there was a better place to store my money, I'd put it there. But there's
That's
simply
right.
not.
There's
Than
not.
properly structured dividend paying whole life insurance policies. So what most real estate investors understand is leverage. Most of them, in fact, any of them who've built anything of significance have used leverage with the banks, right? But they always go to banks for that leverage. They use private investors and then they supplement with bank loans.
Yep. Bank or
right?
hard money.
Or hard money, which is very expensive.
Mm-hmm.
So that's where a lot of people start. If you're still there after a couple of years, you're doing something wrong, because that's very expensive money. But leverage. So in this situation, all that cash that you have, real estate investors are usually cash poor or cash rich. They're sitting on a bundle of cash, waiting for that next deal. As soon as they strike at that next deal, their cash is gone until they sell that. They fix it up, sell it, or whatever it may be, whatever their strategy is. This is just a better place to save your money. You store it inside your policy and then you get to leverage it. You don't ever spend your own capital. It's going to stay in there earning uninterrupted compound growth returns for you for the rest of your life. While at the same time, you get like an equivalent line of credit, just like a HELOC with a life insurance company, where you can take money out, put it back in at will. Take it out, put it back in whenever you want. And it's principal only, like you said. Like you are paying an interest fee, an interest rate, but every loan you make back, it goes straight towards the principal to knock that down. So
that's right.
That's one of the best features of this. So
I'll add this, Dave, to just the speed at which that you can get to that money, right? Where there's no, you get this question sometimes from new clients, right? Where it's like, well, what is the application fee, or what is the fee for a policy loan, or how long does the process take? And I'll go in I'll share the screen and I'll go in and show them my personal policy. Watch this.
Yeah.
30, in 48 seconds, I can request a lump sum of money to come hit my checking account, either direct deposit or via, a check that they send through the U.S. Postal Service.
Yeah. So definitely do the direct deposit.
But anyway, the speed at which you can get to the capital that you need, kind of like Nelson Nash talks about in his book, where he had that army buddy that needed to sell some land for pennies on the dollar, and Nelson was like, hold that thought, let me go down to the State Farm guy and get some money. And then he did it again, years later, right? The same guy was like, well, I underestimated my need for capital and I'll sell you this land even cheaper now. And then he talks about going to the European vacation for a month, whatever, and having never seen the land.
Yeah. Right. So access to capital, and that's what you have.
Right.
And then another piece of that is, once you take out a big loan to go buy your next property, guess what? Now you have a perfect place to save that money.
That's right.
As your revenue starts coming in, or fees that you charge people, or whatever it may be, your maintenance expenses, everything, anything that comes into you, now you have the perfect place. You just repay that loan. It goes back to the principal and becomes available to borrow again right away. But it's like you just dug a big hole in the ground, and now you have you have some more dirt. Anytime you have more dirt, you can fill that hole. So you can just fill it all up until you're ready to use it again. So yeah, and it's so safe. And what if you've been in real estate for long enough, you've probably been sued. You've been a part of a lawsuit, or you will be. And one of the best unknown benefits of cash value life insurance is that in the majority of states out there, it's all state specific, but the majority, 100% of your cash value is protected from creditors. So they cannot come after you. They can come after you. They can't get to your cash value, which is, that's pretty exciting as far as covering your, protecting your stuff, protecting your assets.
Yep.
So, all right, well, let's move on to another one. How about liquidity? I mean, we alluded to it. Like, real estate investors need liquidity. If you don't have access to liquid capital, you can't go buy another deal unless you're mortgaging another property you have that has equity or something. So yeah, that money's there for you. You can take it in and take it out, put it back in at will.
I think oftentimes, this is all, I'll just say it now. This is all kind of under the umbrella of controlling the function of banking in our lives, or the life of your business, whatever that is, right? We should be in two businesses, whatever business we're in, rehabbing or wholesaling or real estate, let's say, in this case, and banking. What often happens, Dave, is if we don't control that banking function, now I have a liquidity problem. I see this next property, but my bank's not giving me the HELOC I need on the equity on the last property. So I have a liquidity crunch. Either I'm going to see get private money, hard money, or what, right? Or I just stall out.
Yeah.
And I have to wait I have to save, I have to capitalize over a period of time to go then take down the next property, right? And I see this all the time on that Facebook group that I'm in, where people are just constantly undercapitalized, or constantly asking about getting a HELOC on a rental property. Oh, my bank says they're not going to do it, on a rental property.
Yeah.
Not saying some banks won't, they will, but good luck finding them in particular times, especially in these times now when they're starting to tighten the belts over there.
Yeah,
the banks.
Exactly. So liquidity is important. And while we're on the subject of liquidity, understand, and this is a hang up a lot of real estate investors have that we've worked with, right? Where they cannot get over the first couple years of not having access to all of the premium that you've paid.
Sure.
So like, say you have a $20,000 premium in the first year, you're not going to have access to all $20,000. I mean, and that only makes sense, right? They got to pay people at the company. You're getting a permanent death benefit, probably, in the millions.
Many times over what you're paying in premium is your death benefit. Many times over.
As it should be. I mean, it's insurance. That's just the way it works.
Of course.
So yeah, so you are not going to have 100% liquidity right off the bat. Now we can get pretty close. But I'm not going to say numbers or anything like that, because it's all very specific to the individual and how much they fund and how much they overfund in the first year and their health and everything else, right? But you can get pretty darn close to a pretty good, what I would call loan to value on your money in the first year if it's designed and you have the capital to design it, in that way.
Yeah, no question. I mean, there's this trap of short-term thinking, especially with people probably our age and younger, where we have this instant gratification society that we live in, where we have access to information at our fingertips, on our phones. Well, Nelson talks about startup costs, capitalization phase of building this business. This is a much easier banking system to start and to build up than if you went down to the state and try to get a bank charter. First, you have to go out and find all the capital, and then you got to get,
Yeah.
And he explains a little bit of it in the book, and it's a big pain in the butt. And most likely, he says, not going to happen because there's 50 other people that want to start a bank as well because they know how profitable banking is.
Yep.
So I often tell people this. I was like, listen, if you want to do IBC, you have to be able to think beyond next week or next year. This is a lifelong process of becoming our own banker. It's going to take the average person nowadays 20 years, maybe longer, to become our own banker. Okay.
And explain that a little bit, because we're not saying it takes 20 years to start benefiting from this.
No, that's not what I'm saying. Okay. So let me get back to liquidity. We'll use simple numbers. Let's say you put 10,000 into a policy that's designed for IBC. 2 weeks after you open that policy, you have access to cash value. Let's say you made an annual premium payment of $10,000, and let's say half of that was paid up additions or something.
Yeah.
2 weeks after you open that policy, you would have access to, let's say, $4,800 out of that 10,000, right out of the gate. So that I'm not saying you have to wait 20 years to get to your cash value or even next year. It is literally weeks. What I'm saying is that it's going to take a lot of time to build up ample capital to completely finance the needs of life.
Yeah, all the needs of life. And you're talking all like your home, so you don't have to go to the bank to get and do a mortgage for a $500,000 property or something like that.
Let me give you an example. I've got a new client last couple months named Chris. Great guy, super intelligent, super analytical. We designed his premium around obviously his income level, and he's an accredited investor, very, very bright. But he has a goal to trade out mortgages on rental properties. And he's like, okay, I'll be able to trade that one out at year 4. I'll be able to trade this one out at year 9. I'll be able to trade out primary residence at year 15. He's thinking long range. Mm-hmm. So he gets it. And so don't think you're going to become your own banker tomorrow. It's going to take a long time. And I'll ask this question, just do we ever outrun our need for finance? No. We're always going to have a need for finance.
You're always going to have a need for finance.
Always.
Right. So you got to have money to live in this world. It's just the way it is.
That's right.
Yeah.
Anyway,
so yeah, and you make a good point. You use some numbers there that it's just a random. I mean, those are made up numbers, so don't hang your hat on anything like that. The fact is, you pay your premium, you're going to have access to typically the majority of that premium in cash value that you can start utilizing right away, within a matter of weeks.
That's right.
So so we'll just leave it at that.
It's very liquid. I mean, it's not.
Yeah. Very liquid.
Yeah, very liquid.
Yep.
Which is why people do it.
Yeah.
One of the reasons.
And protected. So, another one, sticking with the themes of L words. So leverage, liquidity, and then loss proof. So I love the word loss proof because I don't want to lose anything. I've lost enough in my life. And if you're in real estate, you're probably going to lose something. You're going to lose at one point or another. Hopefully you win more than you lose and you end up on top. But
that's right.
Your capital is loss proof. And so actually, let me take a couple steps back, because I think there is another good analogy to like that liquidity that you lose over the first few years. Talking to real estate investors, it's kind of like an escrow account. Let's say you pay $10,000, $6,000 shows up as cash value. So you don't have access to $4,000 right away. Okay. These are just round numbers. That $4,000, you could imagine like it's going into an escrow account. And every year after that, a little bit of that is going to be returned to you. And it's going to be returned to your cash value until at some point it's all been returned to you and you've hit your break even. And then after that, it's going to exceed everything you've ever put into it, like dramatically. The longer you live, the better it gets. So it's just another good analogy to think of it in real estate terms.
Yeah, I like that.
Yeah. So I think I get that one from John and John.
Perfect.
So yeah.
Thanks, John.
Thanks, John. But loss proof, like it's not tied to the market. If you're using whole life insurance, if you're using IUL, it's going to be tied to the market. You may not lose, right? Because they usually say you have a 0% floor. But that's a whole nother. If you want to hear our take on why IUL Universal Life is not right for IBC, it's another episode we've already done. So, but it's not volatile. Once that cash value shows up there, it cannot be reduced. Once the dividend's been declared, they cannot take it back.
That's right.
So, like, you're not going to wake up tomorrow and have less cash value than you have today if you haven't taken you just won't have less cash value.
It's going up today.
Right? It goes up.
Going up tomorrow.
Goes up every day. Every day.
Every day.
Like this year, what the market's lost, call it what, 25%?
Yeah, 20%, I guess.
Okay.
On what
So they maybe rebounded a little bit from the very bottom. But how much have you lost this year in your cash value?
I've gained.
Yeah, right. Nothing. I've gained every single day. So it's pretty nice to have that peace of mind waking up like, I don't track the market on a weekly basis, even a monthly basis. I catch it when I'm at the gym because they show, they always have like garbage on TV.
Yeah, Bloomberg's constantly streaming
at
the gym, right?
Yeah, just to make people mad so they lift harder.
Listen to these people talking about the inverted yield curve.
Or listen to Jim Cramer give his top pick. So basically anything Jim Cramer says, do the opposite, and you'll probably end up a lot better.
Well, he's got the insider knowledge at Goldman Sachs, right?
Right.
He came from there, right?
Yep. He's one of the golden boys.
Yeah.
So, yeah. So I don't know anything else on the loss proof aspect.
The only thing I would say is we're not comparing infinite banking, dividend paying whole life insurance to the stock market in the sense of this is an investment, like whole life insurance is an investment product. It's not. We're just talking that there's no risk of loss, right? It's a guaranteed contractual agreement between you and the company. You have your guaranteed values, and those are literally what it means, guaranteed.
Yeah, I think the only time you can compare it to the stock market is that's one of the only other places people understand where they can put their capital and keep it liquid and hopefully earn on it.
Yes.
Because you can't do that in the bank. You're not going to earn anything in the bank, right? So if I want to earn on my liquid capital, I need to.
You have to put it somewhere.
I got to put it somewhere. So the only place people know of really is the stock market, and hopefully they can time it right so that when they need it, they take it out and it was worth more than they put in. But then they got to pay taxes on the gains and everything else.
You run into the trap though, and I know some folks that are in a similar boat, but they have a lot of their liquidity, I think, in the market. So, let's say it's in an S&P 500 index fund. Okay, you had X amount a year ago. What is that amount today? And it's likely gone down by 15 to 25%, depending on, what fund you're in, right? So now, does that delay something that you want to do later? I don't know.
Maybe because they don't want to take it out right now because they want to wait for it to rebound.
Yeah, that's
so
right.
they're not looking for opportunities. And if one came along, they'd probably pass on it because they don't want to lose what they've got in the market right now.
Right. Which makes sense, which is a smart thing to do. We don't want to lose that value, but you've you've handcuffed yourself by just, I don't want to say getting greedy, but if I see an opportunity, I want to be able to act now without any regret. Like, hey, life insurance cash value, hey, it's gone up every day. It's going to continue going up every day, whether I leverage the money or not.
Yeah,
right?
exactly.
So
great. So
just
no
give you
buyer's
that more
remorse.
certainty. Yeah, you can just act because it doesn't matter.
Yep, exactly. Cool. Well, that's great. Well, so let's talk. This is going to be a longer episode than usual, but I think it needs to be because real estate investors, there's a lot to think about, and there's a lot of them out there, and a lot of them have questions about this. They're starting to see it being popularized, and depending on who they're listening to and where they're learning that information, it may, they may be learning the wrong stuff.
Yep, no question.
So what have we seen? I don't know, maybe let's break real estate investors up into two groups, like the single family investors and multifamily investors, just to make this easy. We've both been single family home investors. We both have rental homes, or have had, in my case. One reason a single family rental home owner might want to use IBC is you're collecting rent every single month, right? Well, hopefully your tenants are paying you. But you're collecting that rent. If you're collecting $1,500 a month in rent on one home, you're not spending $1,500, right? You're paying the mortgage, which is going to be less than 1,500. Let's say the mortgage is 1,000.
Otherwise,
Then,
it's not investment.
otherwise, it's not
sell that.
Right. And then, so now you have 500 of surplus, but you have a lot of other expenses, right? You have, when people move out, move in, you got, time when it's vacant. So you got a vacancy rate, you got maintenance expenses when you own a home. I had to replace an air conditioner that cost the entire year's worth of cash flow in a single one fell swoop because I had to replace $5,000 air conditioner. Right. You have all these expenses. So you're smart not to spend all that money because those expenses are coming up. So that money's got to go sit somewhere. Well, why not let it sit in the most efficient and beneficial place for you, which is dividend paying whole life insurance. So perfect place to capture that rental income that you need to earmark for future expenses.
I have really nothing to add. I couldn't agree more. It's literally partly in what we do, right? We cash flow from our one remaining single family rental that we have. And yeah, that money goes somewhere. Part of that goes to the mortgage to pay it every month, right? And the cash flow is premium. It's either premium or loan repayment. It just depends.
Right. So actually I have one client who we created a policy, and really how we came up with determining what the premium was going to be is we looked at his rental income, and he had about, I think if my memory serves me correct, he had about $48,000 a year of rental income, like cash
Very
flow.
nice.
48 grand of cash flow coming in from all of his rentals.
Very nice.
And I said, what if we just capture half of that as premium? So we did that. So half of his cash flow is coming in and going straight to fund a premium every year. And now that money, that cash value is sitting there waiting for him. And he's already used it multiple times to do the next deal. So it's just a revolving door right now of credit for him. So, and it's phenomenal. And it doesn't, those loans that he takes, they don't go against his debt to income ratio.
Yep, that's right.
It is not debt. It's not reflected as debt. So that's another bonus they don't talk about.
Dave, that question comes up sometimes is, and I guess my answer varies depending on who I'm talking to, but people realize that, okay, this is not generating a 1099. It's not being tracked, by the IRS isn't like in my policy, seeing how much cash value I have. What is a lender going to consider my life insurance cash value? Right? Am I going to have trouble getting a loan from a lender? Has your client experienced any issue with his banks doing what he needs to do?
No, not at all. Those, I guess I haven't talked to him specifically about that. I don't. So, but I would say no. There's no way for that to count against you. That cash value that you have available still to loan against, that's an asset. And banks understand whole life insurance cash value. If you ever filled out mortgage paperwork, under all the assets, one of them that they have like in the drop down menu is cash value life insurance.
Yep.
Like it's an asset. And it's just as good as cash.
Yep. Absolutely.
Yeah. Right. So how about syndicators? So we've got some people we're working with right now going through the underwriting process who are syndicating apartment deals. And I can't think of a better opportunity for somebody to capture all of the money slipping through their hands every month than syndicators. So, what are some ways syndicators could think about this, and how could they utilize IBC?
Well, I always think about those acquisition fees.
Oh yeah,
which can be massive depending on how big the
six
property
figures.
is.
Yeah.
Another one, Dave, is, and I actually put that on my Facebook probably a few months ago. I was like, yes, those acquisition fees ought to be premium first.
Yeah.
Before they go do whatever the heck they're going to go do. Save it, spend it, do the next deal with it, whatever. The other thing is that a lot of these places, 200, 300, 400 unit apartment complexes have massive CapEx budgets, right? Because they're buying these properties from these old operators, let's say, that have owned them for 20 or 30 years. There's a lot of updating that needs to be
Sure.
done, restriping of parking lots. We add a little dog park, or we add a little jungle gym. We have this,
Laundromat, or they renovate
yeah,
units as people move out. Yeah.
that's right. And we have, this baseline package that we do to turn the apartment that costs $10,000 per unit or something, granite countertop, stainless steel appliance, whatever it is.
Right.
All that money just sits basically, like you said, like in an escrow. It sits in probably a business checking account or something.
Yeah.
Or in an escrow where it just sits there.
And it's exposed. Let's not
It
beat around
is.
the bush on that. That money is exposed right now because, one, if you have any confidence in the FDIC insurance, that only covers you up to $250,000 and not in a single account. It's not like per account. Like it's per account holder is my understanding. So you could have $100,000 in 4 different accounts. You're still only covered for $250 total. Right?
Maybe.
Okay.
Don't quote us on that, folks.
Okay. Well, look that up. Fact check that yourself, but that's my
Right.
understanding. So you can't spread your capital over several accounts and keep it all in the same name and expect it for all of it to be covered if it's over 250. That's my understanding.
Yeah. And I'd say this as well, Dave, that's because it's a great point, is the FDIC is not fully funded, hasn't been for years anyway. I think
Right.
it's, less, there's, whatever X trillion amount of dollars on deposit at banks at any one time. And the FDIC can meet, I think, maybe
1%.
0.5% or something.
Yeah. Yeah. 1%
at
at
any
tops.
So it's
Right.
it's not real insurance. It's just, if you know the history, you have to do some reading. But it's not what you think, folks.
Yeah. And read, if you think your money's secure because of that, there's also a little thing called the Dodd-Frank Act that was
bail in. Yeah.
bail in. So research that, Google that, Dodd-Frank Act, bail in, as in like a bail of water, bail in. They're not going to bail out the banks anymore with taxpayer funds. They're going to bail in the banks with your personal funds that are already
Deposits.
in the banks. You're an unsecured creditor. That's it. They have right to your money. So just another reason I don't keep any money in a commercial bank that I don't need to pay my bills.
Thanks, Barney.
Thanks, Barney. Class act. He's doing it for you, the consumer. Don't worry.
That's right.
Yeah. Okay.
He's retired now, so we can poke fun at him.
Yeah. Yeah. Well, we can poke fun at him anyway. Freedom of speech.
That's true.
Yeah. Although I think it may be a hate crime for him, in some people's minds. But
right.
What other money do syndicators have flowing through their hands every month? Like, it's all that revenue, right? And then they're like, how the syndications you've been a part of, you receive quarterly payments?
Yes, I've had one that was monthly, and then the other ones have all been quarterly. But you're right, that money sits right before they send it out to, if you're you're in a preferred position, let's say, as a limited partner in this syndication, right, where you get paid first if the cash flows allow.
Yep.
Right. Well, yeah, that money is sitting anywhere. So, there's definitely creative ways, Dave, to capture a lot of the dollars that flow through their hands, which is, hundreds of thousands of dollars a year. That could be, a lot of it could be premium, and it's simply not.
And it's just a matter of sequence. Sequence your dollars through the policy before they go out to your investors. Sequence them through the policy before they pay your semi-annual property tax. Sequence them through the policy before you go, retar the driveway or put in a dog park. Right? It's just sequence.
Right. It's all, and I've seen that done at every syndication I've been in. There's always been either a dog park or a jungle gym or resurfacing, or that money was put to one use. It did just the resurfacing.
It's just one job.
$20,000 gone.
Yep.
That could have been PUA premium first.
Yep. Right. So, well, good. So, and we've worked with a lot of real estate investors over the last several years, and we've discovered a few things. And I think one of the biggest things that we discover with real estate investors is they're not patient. real estate investors, and rightly so, they want to have their money working for them. They understand velocity of money. But what they don't understand is, like, going back to what you had said earlier, that a lot of times they're very short-term thinking. They just think the next deal, the next deal. They're not thinking 5-10 years into the future. So they don't have the patience to hold on to that cash, get approved for a policy, and first make it premium first, and then utilize it and then leverage it. So that's the biggest thing I've seen. The biggest drawback of working with real estate investors that they need to get over.
Yeah, I think you're right. I also think that just from a business planning perspective, Dave, whole life insurance is a great way, and we've talked about it, but just to touch upon it again, is a great way to fund a business succession plan, whether it's a buy-sell agreement or some other agreement that your lawyers draft up. But the best way to fund those agreements is with permanent insurance.
Yep.
In this dividend paying whole life, you're able to maintain much of that liquidity that you do need. And I think that's a question I would ask now as a lender into these things, or a limited partner, is like, hey, tell me about y'all's insurance plan. What happens if this key person, who is the personality of this thing, he's the deal maker, he's all these things for you guys, because he's usually pretty small, right? There's only a handful of key people.
Yeah.
4 or 5 guys or gals. What happens if you lose him or her?
Right.
How do you replace him or her and still maintain, the functionality and the success that you've had? How do you? Anyway, so
how is the loss of that person going to affect the return of my capital?
Sure.
And if you have a massive life insurance policy, that could be another benefit as a syndicator
to attract other capital.
Like, oh, your question, great question. If I get hit by a bus tomorrow, well, guess what? I have a $5 million policy, which is enough to pay every one of you investors back. So there you go.
That's right. Make me a beneficiary.
Make me a beneficiary. I mean, there's a reason when you go get a small business administration loan, they insure, if you're going to get a $5 million loan, they want to know you have $5 million of life insurance in place, because if you die, they're getting their money back.
Oh yeah.
And if I'm an investor, I want to be treated the same. So There you go. What's another one? What's another hurdle that a lot of real estate investors need to jump?
Well, they haven't been, if they've dug into IBC, they haven't dug into it enough, Dave, and they don't understand that this product will enhance whatever they're doing.
Yeah.
And yes, we've addressed the startup costs, but over the long term, if you took 2 people, and I've said this before, one person is doing IBC, the other is not, like say they're twins or something, right?
Mm-hmm.
Twin IBC is going to run away eventually.
Yep.
All things being equal, he's going to run away from the other guy.
Right.
And if you don't understand what I'm saying, read Nelson's book again.
There you go. So that's perfect. And something you said before we even got on this call, and I'll let you say it. What's the quote that you said?
Yeah.
Why don't you say it? Because I don't want to steal your thunder.
Oh, yeah. I was going to say. All right. So they're not thinking in terms of banking, right? Everything that's going on in the financial space is secondary to the banking function in controlling it.
Yeah.
Everything is secondary to that consideration.
Absolutely. Yeah.
You could have the greatest deal in the world, but if you don't control the banking function, or you can't get lending for whatever reason, then it's not the best deal in the world anymore.
Then it's not a deal at all.
It's not a deal at all.
Right. Yeah. It starts with the banking. That's it.
It all leads back to banking, the function of banking.
Yep. All right. So yeah. And that plays into this characterization, which I found is real estate investors think as investors only. They don't think like bankers. So if you want to be the best deal maker out there, I guarantee, I know the best deal maker out there. I've worked with him on many deals, and you know who I'm talking about. He's the best deal maker I've ever met in my entire life. And the reason he's the best deal maker is because he understands banking like Warren Buffett understands the stock market.
Right.
He understands banking, and every single thing goes back to banking, period, with him. If it's not bankable, It's not a deal.
Yeah,
That's
he's
it.
forgotten more about banking than
We'll ever learn.
ever know.
Yeah, exactly.
Right.
So, so that's just firsthand.
I think
proof.
that's such an important point. And maybe they don't understand something. We throw this term banking around and the banking function. Maybe there's a misunderstanding in some people's eyes because they haven't been able to put in the work or haven't been willing to put in the work to understand, what that means.
Yeah.
Right. That's the essence of what Nelson is trying to explain to us here in his 92-page book.
Well, the truth is, I mean, bankers, like central bankers, don't want you to understand banking, or else you would never keep your money with them.
Well,
right. So
Right.
It's hidden for a reason. So you really have to want to understand it and want to learn about it in order to become knowledgeable in it. That's just a fact. It's not going to happen by accident.
Yeah, no doubt.
Yeah. So another thing is investors like to focus on, their biggest focus is maximizing the return on investment with every dollar, the rate of return on every single dollar they have. It's focused on, let's maximize that one rate of return we're after with this one deal, instead of thinking, how can I multiply my rates of return with the same dollar? So what infinite banking allows you to do is you get to earn multiple rates of return. Like, would you rather have one or two? I'd rather have two.
I mean, yeah, I'll take multiple.
I'll take Alex,
for the win.
Take multiple for the win. Yeah. Exactly. And that's exactly what you get multiple uses out of the same dollar. And with real estate, I remember reading a Kim Butler book. It was like 9 uses with the same dollar that you get by putting it in cash value life insurance, then leveraging it for real estate.
And let's remember, like, as time goes on, these policies, right, they get more efficient every day. So that enhancement that we spoke of earlier gets better with age, not worse. It gets better with age.
I mean, I know what that's like, so I can relate.
Yeah, I mean, like a fine wine here.
Yeah. So I mean, getting better with age, there are ways to do it. Yeah. So, and then you had one final comment here, and then this is the longest episode we've ever done.
I know.
So we'll close it out here shortly.
Yeah, I think just the volume of interest, not only business owners or just everyday people, right, that is paid to other banks throughout our lifetime. And again, I'm going back to Nelson again. 34.5 cents out of every dollar earned or spent is paid in interest to someone else's banking system. Doesn't matter what bank it is. Local bank, big bank, doesn't matter. Finance company, mortgage company. Get that back. You get that back with IBC. That right there has enormous value. Right? If you could take a third of all that money that, the 100% that's going out, if you could recapture a third of that. Yeah. You're already beating your neighbor who's doing things the way every other person in the country is.
And that's what really matters, right?
To do it.
Yeah,
because what you do is compared to what everyone else is doing.
Right. Wealth is relative.
That's right.
How you do is relative to how everybody else does. So, like, as we've said many times before, the banking process is going to happen whether you are involved in it or not. So get involved in it.
Say that again.
The banking process is going to happen whether you're involved in it or not.
Man, it got better with age.
Yeah, absolutely. Just like these policies. So. Well, all right, man, I think we covered a lot of ground in 48 minutes. So we'll leave it at that. So hopefully all you real estate investors got something out of that. And if you guys want to call us, shoot holes in what we're saying so we can help you understand this process better, because that's what you do. Just like a good real estate investor is going to look at a deal and they're going to shoot holes in it, and they're going to say, what if? They're going to look at all the different angles of risk. Let's have that conversation. We're happy to do that and answer any questions you have, and we'll shoot you straight. So feel free to write us in with questions or schedule time with us. Happy to talk. All right. Well, we'll see you guys all next week. You have a good one.
Yeah. See you next week.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.